Welcome to Rational Investing. My name is Cameron Stewart, CFA. Thanks so much for watching the channel. I greatly appreciate it. Throw a comment down below. Helps the old algorithm. Let's dive into Pepsi Company this week. I want to look through the cash flow one-pager. We're going to look at 10 years of history, and we're going to review the 5 key factors that we use here at the channel to understand, is this stock worth additional due diligence? And those 5 key factors are as follows. Number 1, top line revenue growth. Can you grow your revenue? Number 2, earnings. Can you grow earnings? That's enterprise level earnings, EBITDA, operating income, something at the enterprise level, not earnings per share. Strong free cash flow. Obviously, you got to turn that earnings into cash flow. I want to see low debt. I want to see a well-priced stock. What is a well-priced stock? Somewhat subjective, but basically with a conservative forecast out in the future, we think the current stock price has a high probability of beating the stock market. That's it. Pretty simple, hard to do. Let's dive into this stock and see what we learn from Pepsi. All right, so we're inside the cash flow one-pager. I want to take a look at Andre's phenomenal analysis on Pepsi here, kind of going through and talking a little bit high level about what the company is and so forth. 200 countries and territories, an absolute monster beast of a company. Well-known brands, obviously Pepsi, because that's their brand, top brand, but Lay's potato chips, Doritos, Cheetos. I mentioned Pepsi Cola, Mountain Dew, Quaker. In terms of their revenue distribution, right? So there's 7 segments: Frito-Lay, Quaker's Food, Pepsi Beverage, Latin America, Europe, Africa, and APAC. For their distribution, looks like Frito-Lay is 27% of the overall business in terms of a total size. What brands do they own? Here's some more brands that Pepsi owns, and let's dive into the one-pager and really take a look at some detail. Let's dive into the cash flow one-pager right now with Pepsi. Let's review the first key factor that we look for is revenue generation. Can Pepsi grow its revenue? Well, they had $63 billion of top-line revenue in 2015. That was basically flat for a couple years. Then it went to 64, 67, 70, 79, 86, 91. That's a big jump in 4 years from COVID at 70 billion, and then they went to 90 billion just in 2023. 91 billion. Now 92 billion last fiscal year of 2024. They're approaching 100 billion of revenue. They'll most likely get it given this track record. And then annual growth rate is 4% a year, slightly above inflation for Pepsi's top line revenue. Now, how does that translate into earnings? So we pull EBITDA, enterprise level earnings, that's $10.8 billion in 2015. 12.6, 12.5, kind of flat in there, just what revenue was flat between 15 and 18. And it looks like it moves up a little bit. 2019, it's 13 billion, 13 billion, 14, 15 billion, 15.5, and then last year it fell to 12.7. There's a 2% annual growth rate here over the 10 years. So someplace between 4 and 2%. This last year in 2024 looks like it dipped a little bit. That's holding down this annual growth rate because we're just picking up off this last digit, this last year of 2024, and looking between 15 and 24. If they rebound back to $15 billion, that growth rate's going to go up, but it's probably sitting around someplace between this 4 and 2%, right around inflation. Right, inflation's been at it's kind of pumping around a little bit, but it's 2, 3, 3.5. Someplace in there. These Pepsi earnings are basically inflation. We're not seeing a whole lot of extra on top of inflation, which would be real earnings growth, right? You've got your nominal versus real. If you're hitting inflation, you're just simply the real growth rate. The nominal growth rate. You're not adding real earnings growth, which is what we would like to see. And I think that's one of the reasons why I think the stock is going to underperform. Their inability to grow revenue at a rate that keeps up with that's a bit higher than inflation. But I digress. Let's continue. The debt level of the business, $33.6 billion in 2015. That's grown to $47.8 billion last year. Because of the earnings dip, that's putting their debt to EBITDA ratio above our threshold at 3.6 times. And you can see historically that's the highest debt ratio they've had in the last decade. they have two options. One, grow earnings, get back in there, or buy down debt, one of the two. I'd suspect that they would be buying down debt in 2015 on top of hopefully growing earnings, but kind of doing a combination of those to quickly bring that below 3. They really don't stay above 3 times in their past very long. You can see in 2020 during pandemic, they hit 3.4 times levered and quickly bought it down in 2021 cash flow. They bought debt down by $4.1 billion just like that to try to get leverage under control, because the investors are not going to want to see that. So I would imagine in 2025, they're going to use some free cash flow to buy down the debt and or grow earnings. Excess free cash flow isn't that large, kind of come down a little bit. I wouldn't worry too much about that. Market cap, $150 billion in 2015, grew to $215 billion over that decade. So that's about $65 billion increase in the market cap of the business over that 10-year time frame. So I look at 215 billion. Let's do some math here. 215 billion divided by 148 billion. That is a 45% increase over the decade, a 12% growth rate in the market multiple over that decade period, which is surprising because earnings are only growing at 2%. Why would the market cap grow at 12% if earnings are only growing at 2%? Well, that's the second piece that you need to come up with a stock price, right? You've got your earnings and then you have the market multiple. So what happened to the market multiple during this period of time? Well, in 2015, you could buy the stock for 16, 17 times EBITDA. Right now, late last year, it's trading at 20 times. So you get a market multiple expansion from 2015 to 24. Earnings grew, even though last year earnings were down from 15.5 billion to 12.7 billion. It's still up from a decade ago of 11 billion to almost 13 billion. So that extra market multiple expansion of about 4 turns of EBITDA from 2015 to 24 expanded the market cap for nothing more than greater demand from investors. And that demand can cycle on and off. And if you look historically, they don't trade at 20 times very often. In fact, this is the only time in the last decade that they're sitting at 20 times EBITDA. I would expect either one, earnings to come back up around 15 billion, or two, market multiple to come back down on those earnings. That's going to limit the potential of the return on the investment. So I think that's a big cautionary tale here. Let's take a look at free cash flow, right? That's the real heart of the matter here. How do you value business? It's on the free cash flow. 2015, they had 10.5 billion of free cash flow. You'll notice this number is extremely close to the EBITDA. You would think there'd be a bit better of a gap there. Generally, you have taxes, some working capital changes, some other cash expenses that come out between EBITDA level and cash flow from operations. Interest expense would be one of those, plus taxes. But these numbers are surprisingly similar. I'm not a huge fan of that. There's probably could be a growing tax liability that's not being paired. And then look at this. So this is really 2015, 2016, $10 billion. And then free cash flow from operations declines in 17, 18, and 19, the years 2017, 18, 19, down to 9.4 billion. At the same time, you can see EBITDA growing from 10.7 billion to 12.5 billion. We don't like that. I don't like to see cash flow from operations going the wrong way from EBITDA. On a company like PepsiCo, that's a little odd to me. You can see then it reverts back up in 2020. They must have sold through a bunch of inventory or something like that, because cash flow went up in 2020. You would have thought it would be the opposite. EBITDA's flat, cash flow goes up, and then cash flow moves from 10 billion in 2020, 11, 10.5, 13, and 12. kind of bumping around. But that's a 2% growth rate over the long term. That's following the 2% EBITDA growth rate over the long term. So I don't think there's anything funny going on here. It's just a little odd, a little commentary of cash flow didn't really follow EBITDA like I'd like it to see it every year. And I think the cash flow from operations number by itself is just too close to the EBITDA number. There should be some interest expense out of there. There should be taxes that are being paid in cash. There should be a bigger gap between those two. Just a smell check for me. Okay, so last year in 2024, they made $12 billion of cash. What do they do with that? Well, they peeled off $5.3 billion to put back in the business. Last year, they borrowed a little bit of money, $700 million. A little bit of money, $700 million. But that basically left them with $7 billion of cash flow available to equity holders. So that's cash flow from operations minus capex. I'm going to put the debt offside for a second. Just call it $7 billion of free cash flow to equity. Then what are they doing with that? You can see that they're buying back shares. A lot of these mega cap companies do it. They do a great job and that's how they grow their earnings per share at above market rate. If enterprise level earnings are growing at 2% and I'm shrinking share count at 1%, then I'm kind of growing my EPS at 3%, which is, I guess, slightly above inflation, depending upon where you measure it. But that's not really what we want to see in a business. I want a business that's going to grow its earnings much faster. And then on top of that, if you buy back shares, it's even higher. But that's one of the problems, I think, with some of these massive portfolio companies of retail products. They're unable to really grow that quickly their main earnings. But I divide cash flow from equity by shares. I get free cash flow per share. They're basically producing $5. On the high end, I wouldn't take this as numbers too high. About a $5 free cash flow per share. You're buying it at $150. So what's 5 divided by 150? That's a 3.5% free cash flow yield, which is a low yielding cash flow, especially for a business that isn't growing that quickly, right? You think of low cash flow yielding stocks, such as your Amazon, your Microsoft, your Meta. These guys are growing really quickly, and as a result, they deserve a growth multiple. So their free cash flow yield is much lower. Because they're growing so much faster, you're paying a premium. Here, you're paying a premium for the stock. It's trading at 20 times, but they're not growing their earnings. So I think that's a smell test for me that I'm like, there's too much downside risk here. And I think the market is seeing that, and that's why you're seeing the stock come down. Let's take a look at the forecast Andre put together. So here we go. He's got $14.5 billion. He's going to grow that long term at 3%. Got a little spike next year, which is what I was saying, that you're probably going to see a little reversion back to the mean of some one-time costs here that struck in 2024. Their earnings power is high enough. They should be able to get that back to $15 billion pretty quickly. He's got them back at $15 billion in 2026. Okay, and then he flatlines it at 3%, which is basically inflation going forward. I think that's correct. He's applying a 16 times market multiple. Excellent market multiple. He was not fooled by the recent premium you're paying in the last 5 years, that market multiple being north of 17 times. For what? For a company that's growing earnings with inflation? That's not what we want to see. So he's bringing that down to add a little cushion in his forecast. And out he's saying, okay, stock's worth $200 out 10 years from now at a 16 handle. Okay, what happens next? Let's take a look at free cash flow. Like I said, $5 in change is basically their free cash flow. This is what happens when they return back to about $15 billion of top line EBITDA. They produce about $5.50, $6 of free cash flow. That's going to grow over time to about $7.32 out 10 years. And he's going to apply a 4.5% yield to that number to create a stock price, $162 out 10 years. Remember, yields you divide to get the expected number. Multiples, you multiply to get the expected number. So in the EBITDA market multiple case, you take EBITDA times your market multiple, you get a stock price or market cap. On a yield base, you take your free cash flow and divide by the yield, you get the stock price. You can do the same thing with dividend yield, by the way. Take your dividend, divide by dividend yield, you get the stock price. So we're going to average these two, $200 on one method, $162 on another, and we're going to call it, it's going to be $180 out 10 years from now. Well, now we've reviewed the stock. Now we can look at the Yahoo Finance or wherever you go and say, okay, what is the stock trading for today? I'd highly recommend that you don't look at the stock price until you do your analysis. What do you think the stock is worth? Then go in the public market and see what it's offered at. Because remember, Mr. Market's always offering a price that doesn't mean it's rational. Come up with your value, then look out and see what the world's trading for. So you can buy the stock for $147 today. I get this stream of cash flow here. I'm out for $180. That's a 7% IRR for a 10-year hold. And I think that that low IRR is twofold. One, it's the market multiple compression, 20 to 16. That compression's limiting your upside. And number two, it's relatively weak earnings growth. 3% earnings growth is barely keeping up with inflation. So you're not going to see an outsized return here because you're not getting what we like to look for is that real market multiple expansion. Right on the channel, we have something called the trifecta. That's where we have a stock that hits all five factors, but there's like a couple extra that we really want to see. Number one, buying back stock. You want to see a company that's buying back stock. Number two, you want to see a stock that's growing its earnings quickly, enterprise level earnings. And number three, you want a stock whose market multiple can expand. In this case, it's the opposite. You're going from 20 to 16. That's going to weigh on the return. You want the opposite, right? You want to buy something at 16, have it expand to 20 while earnings are growing. That's actually what happened in this stock over the last decade, where it expanded from 16 to 20 and earnings went from 10 billion to 12 billion. That's how you had a 12% annual growth rate in the market cap over the last decade. I don't think that's going to happen going forward. So this has been PepsiCo diving through the cash flow club. If you like this type of analysis, we've got CFAs. Congrats, by the way, to Thomas. Just sent me his paperwork. I'm going to endorse his CFA designation here in a few minutes. But we've got CFAs. We're publishing content. Dive in. You can chat with them. There's a correspondence there. Happy to take recommendations. If you want me to do your stock as a video, I can go do a custom one-pager. Hit my Venmo up in the link down below. Happy to do that. Make it meaningful. Meaningful donation for my time. Thank you. Let's see. What else do you want to see? Let me know what other stocks you want to see. Hit the like, subscribe button. Feel free to share it. Really appreciate the time. This is Rational Investing. This is PepsiCo stock. One more thing I wanted to cover is, are you interested in becoming a financial analyst? I'm happy to train you if you want to learn how to do this work yourself. I would highly, highly recommend that you check out my basic cash flow investing course at cashflowinvestingpro.com. I will teach you how to do this yourself. It's absolutely possible to do. I would highly recommend looking and reviewing every single stock in your portfolio at least once a year. Read the 10Ks that produce, understand your business, understand what management's doing with your money because they are shepherding your money and you want to be careful about what they're doing. Also, if you force yourself to read the 10K every year, it's going to limit your stock portfolio. You're not going to be able to own 100 stocks. You're going to pare it down to your best ideas, and holding those long term is typically the best way to beat the market. All right. Thank you very much. This is Rational Investing, and we'll see you later. Bye-bye.